Good evening and welcome to Bajaj Finance Limited Q3 FY2024 earnings conference call hosted by JM Financial Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Samir Bise from JM Financial. Thank you and over to you, sir.
Thank you, Neerav. Good evening, everyone, and welcome to the Q3 FY24 earnings conference call of Bajaj Finance Limited. From the management team, we have Mr. Rajiv Jain, Managing Director, Bajaj Finance, Mr. Sandeep Jain, Chief Financial Officer, Bajaj Finance, and the entire senior management team of Bajaj Finance Limited. As usual, we will first start with opening remarks from the management team, post which we will open the floor for Q&A. At the same time, I would also wanted to thank the team of Bajaj Finance for giving us the opportunity to host this conference call. With that, I hand over to the management team. Over to you, Rajiv, sir. Thank you.
Thank you. Thank you, JM. Good evening to all of you. Good morning, depending on the geography. I have with me Anup, Rakesh, the two executive directors, and whole host of Atul Jain, Managing Director, BHFL, Manish Jain, CEO, BFSL, and of course, Sandeep. I'm referring to the presentation that we have uploaded on BSE and NSE stock exchanges. We're having some DLP issue on the website, so on uploading it. So please refer to the stock exchanges for the presentation. I'm referring to the investor deck. It's a long agenda. Jumping right straight into panel number 3. As part of this, there are 4 key updates I'm going to share today. First is, of course, quarterly financial performance, update on regulatory matter, long-range strategy, because it's the third quarter of the year, which is really when we annually, last year onwards, started to share our long-range plan, and there are a set of key senior management portfolio changes that we've embarked on. I intend to take not more than 25 to 30 minutes so that I can leave sufficient time for Q&A. Jumping right to panel number 5, executive summary. Mixed quarter, good quarter on AUM, customer acquisition, portfolio metrics, and operating efficiencies. Strengthened capital position with a capital raise of 9,100 crores. Dampener for the quarter were elevated loan losses and impact of regulatory action. Overall delivered AUM growth of 20,700 crores, booked just a tad below 10 million loans, 9.86 million loans, and highest ever new customer acquisition of 3.85 million customers. Bajaj Finserv app now has 49.2 million customers. In terms of AUM stood at 3 lakh, just a tad below 3,11,000 crore, growth of 35%. OPEX to NIM came in below 34% for last 2 quarters consistently. PAT came in at 3,639 crores, a growth of 22%, ROE at 22%, and net NPA at 37 basis points. Some more texture on the quarter on panel 6. Just quickly, you're aware of the AUM growth. In terms of B2B, overall disbursements are up 32% at 21,686 crores as against 16,500 crores. In terms of customer franchise, company now estimates overall customer addition at 13 to 14 million for full year of FY24. In terms of customer overall franchise, we expect to end the year at between 82.5 to 83 million customers. In Q3, the company added 158 new locations and 9,500 distribution points. Overall geographic footprint is now at 4,100 locations. Clearly, cost of funds inching up slowly, but given our diversified profile, it's a very slow movement. In Q3, cost of funds came in at 7.76%. It was an increase of 9 basis points over the previous quarter. Deposits book grew in line with the balance sheet, grew by 35% and stood at 58,000 crores. Deposits now contribute to 22% of consolidated borrowing. In terms of operating efficiencies, net interest income grew by 29%. NIM compression in Q3 was 11 basis points. As you saw, cost of funds itself rose by 9 basis points. And given the increase in risk weights and higher incremental cost of funds across all businesses of the companies on all portfolios, company effective January 1 has increased interest rates by 20-30 basis points to mitigate the impact of higher cost of funds and higher risk weights. In Q3, OPEX to total income, OPEX to NIM came in at 33.9. The companies, as we get into next year planning cycle, the company is working to enhance operating efficiencies by implementing a host of Gen AI capabilities and other digital initiatives to ensure that we can continue to keep bringing this number down. Employee headcount stood at 54,200 people, or 54,300 people. We net added 3,200 people. The annualized attrition came in at 13.8% versus 19.1% a year ago. Credit cost, which as I said was one of the dampeners for the quarter, let me spend 2-3 minutes on it. Loan losses and provisions were 1248 crores. The loan losses were primarily on account of two portfolios of the company. For rural B2C business, for the last 2 quarters they've been elevated. They remained elevated even in Q3. The AUM growth of that business continues to slow down as a result of risk actions. In March quarter, it grew by 26%. In December quarter, that portfolio has grown only by 10%. The second reason why credit costs were elevated in the quarter was urban B2C business. But they were higher due to lower collection efficiencies. The urban B2C portfolio principally sees the transient frame. Rural B2C, as you have observed, continues to be inside our problem. I've said this in previous calls as well. And between risk and data, the call is always risk, and that's why the growth rates of the business has constantly been brought down until such time that we can start to see gross flow rates in that portfolio improve. Annualized loan loss to average AUF, excluding management overlay, if you account for it, was 1.79%. On a full year basis, we expect annualized loan losses to average AUF to hold at 1.79%. It's important just in the context that pre-COVID, we used to be at 1.89%. In FY20, FY18-19, we used to be at 1.6%. We foresee the numbers to continue to straddle between 160 to 180 basis points as we move forward. As a result, GNP and NPA came in at 95 basis points and 37 basis points, remains amongst the lowest, probably the lowest in the industry, and lowest for us by a mile. On a year-on-year basis, it came down from 1.14 to 95 basis points and 0.41 to 0.37. Risk metrics, as I said, across other than rural B2C business, continue to remain in good shape. On panel 8, quickly, as a result of the consolidated pre-provisioning profit grew by 27%, given good control over operating expenses. Consolidated profit before tax grew 22%. As you can see, while NIM continues to soften gradually on account of lagged effects of cost of funds, in Q3 the elevated loan losses and impact of regulatory action has led to profit growth being lower by approximately 5 to 6%. In absence of these two, and there's no such thing as absence of these two, but just at a mathematical level, the normalized frame would have been 27-28%. But that's mathematics. The real numbers are a growth of 22% for the quarter. Consolidated profit after tax grew 22% to 3,639 crores, and ROA came in at 4.92%, and ROE came in at 22%. Capital adequacy remains strong, but as a result of the RBI's increase in risk weights from 100 to 125%, now overall it had an impact of 290 basis points on the company's CRAR, and adjusted for this change, CRAR is now at 22 is at 24. Otherwise, it would have been 26.7. Additional updates are known, so I'm gonna jump forward. Just quickly on BHFL. BHFL had a good quarter. AUM was up 31%. Home loan AUM grew 21%. Loan against property grew 15%. LRD grew 70%, and DF grew 74%, albeit on a low base. Mainly DF, and rural mortgages grew 19%. portfolio composition remains at 56, 9, 19, 10, 4 and 2, which is principally very similar to where it was 4 quarters ago. Net interest income grew 17%. Clearly, there is a margin pressure in that business as well. As a result, the NIM growth was 17%. OPEX to NIM continues to come down gradually and came down to 23.2% versus a year ago of 24.5%. Credit cost, clearly the GNPA stood at lowest in the industry at 25 basis points and 10 basis points. Their profit after tax grew 31% to 334 crores. Very quickly to BHFL. BHFL has started to turn the corner, added 38,000 customers, but principally only organic, does not do business with affiliates anymore, given that the model was not economic in nature, at least from our standpoint, and does most of the business from the FinServ app. Margin trade financing business grew given the changes in regulations. Profit before tax came in at 22 crores for the quarter, and profit after tax came in at 16 odd crores. Continues to invest in new features on the app and web platform. Jumping right over to omnipresence, there is a noise in the data given the embargo. So downloads in the quarter were marginally down post 16th November. Net installs were marginally down. On the next panel, wherever you see stars, principally have a transient impact as a result of the embargo. Otherwise, we continue to invest in the digital assets to make it more, the UI and UX more and more convenient for the consumers. So I would ignore these two panels from a quarter standpoint, given that they had some impact as a result of the embargo. Jumping right over to panel 32 now, which is the quarter-on-quarter. As you can see, assets under management grew 35, NII grew 29, net total income grew 25, pre-provision profit grew 27, and PAT grew 22. Operating expenses to NIM came in at 30.9, annualized loan loss to average AUF, I've already shared the numbers. What I do want to spend 2 minutes is on 9 months so far look like 35% balance sheet growth, 29% NII growth, total net income growth is 26%, and profit after tax growth is 27%. And so far, for 9 months, the operating expenses look like 34%, OPEX to NIM looks like 34%, and annualized loan loss to AUF looks like 1.61%, and ROE looks to be 22.3%. Let's now jump quickly to panel to the portfolio mix, which is panel 49. I'm rushing through a little bit because I have some more sections to cover, some more important sections to cover. I'm on panel 49. The composition of the balance sheet remains largely stable, plus minus 1% on a year-on-year basis. Two-wheeler and three-wheeler instead of 5.1 is 6.2. Urban B2C 20.7, 19.8. Rural B2C, and as I've said earlier, it includes gold loan from June quarter onwards, which is as we get into next year. We'll separate gold loan 8% down to 7. Still does not take into account the impact of gold loan. Adjusted for that, this number would have been like 6%, to the point that I earlier made. SME lending, so plus minus 1%, the mix remains largely same. Jumping to GNPA and NPA data, on a year-on-year basis, marginal movement plus minus. On an aggregate basis, we're down from 1.14%, we're down to 0.95, and NNPA down from 0.41 to 0.37. You see some movements, as you can see, on a GNPA basis, rural B2C is sideways. On NNPA basis, there is a 13 basis points movement, and urban B2C, there is a 18 basis points movement. Mind you, these numbers are lower than what they used to be in pre-COVID times. On portfolio credit quality, the bars that we've been publishing for many years, from a management assurance standpoint, the only yellow remains rural B2C. As you can see, 98.32 pre-COVID is at 97.98, and 1.09, which is stage 2 assets, is 1.5. But since there's a noise in the quarter on account of urban B2C, it's important for me to spend 1 minute on it. Just go back to panel 56. So it used to be at 98% current, it's at 98.6% current, and 143 basis points of stage 3 assets is at 95 basis points. So it's principally a transient moment at this point in time, but we remain watchful. That largely completes the first part of my section on quarterly. I just thought we'll also provide an update to you on the regulatory matter. I'm on panel 60. RBI directed the company to stop sanction and disbursal of loans under its two lending products, mainly e-com and Insta-EMI card, on account of implementation of deficiencies and implementation of digital lending guidelines, mainly non-issuance of KFS statements. In compliance, we've already published to the street that the company temporarily suspended sanction and disbursal of new e-com loans, which used to be 250 to 280,000 loans in a month between marketplace and e-com loans and Insta-EMI cards, effective November 16. Also, it temporarily suspended sourcing and issuance of new EMI cards and levy of annual renewal fee, which is levied on those clients who do not use the card once in a year. Since 16 November, the company has conducted a comprehensive review of the guidelines on digital lending and KFS. It has sent the KFS to the entire active base already and is implementing requisite corrective action. We've scanned through the entire frame to ensure that we are in full compliance of the executive order, and everything else is done except for two areas that we thought from a complete spirit standpoint that we ought to complete, which was a digital signature on every KFS account and a vernacular in 20 different languages given our scale and breadth. So that's just getting completed, and sometime very, very soon we'll be filing for compliance. But these are, given our scale and complexity, were large changes, and that's taken, but we wanted to make sure that we are fully compliant in form and spirit, and that's how we are making sure that we are completing them and filing for compliance. So that's really on the regulatory matter. Let me now jump to long-range plan. We shared last year that the company, for the last 14 years, runs on an annual ritual basis a long-range strategy exercise, which allows us to seize the India opportunity and seize the financial services opportunity. It's the 14th year of our long-range planning process, and as part of that, we published a construct and the strategy. So to state to the spirit of that frame, we are here to share the second update on the LRS 24-25. In terms of business construct, last year we had shared 6 key dimensions which guide our basic construct as a company. It was ambition, strategy, approach, philosophy, market share, and profit share. This year, as part of sharpening the pencil, we've added 2 new dimensions of customer share, which is to grow our share of customer. Acquire and sell, cross-sell has been our strategy, but customer share, which we started to publish 2 quarters ago as part of our product per customer matrix, we thought from a construct standpoint, as the company, the franchise grows larger and larger, it's important to add this dimension as part of our basic construct. So, and the intent is to reduce friction. Intent is to deliver highest customer satisfaction score, and intent is to, in the process, grow products per customer. In terms of technology and data first, while you may say that's really how we built the company over the last 17 years, but it was what we are principally saying is that using technology and data first to solve all our problems and be an early adopter and invest in emerging technologies and data practices, and it should eventually in the process result in sustained growth, superior customer experience, improved productivity, and robust controllership. So these are the two new additions to our construct, and as we continue to grow larger in size and more complex, clearly some of these construct dimensions will ensure that we remain within the guardrails of what the company to be here. This is an update on what we said last year. We last year identified, I'm on panel 65. This is an update on what we said last year. It's good to identify megatrends. How well are we doing against it is more important than identifying megatrends. As you can see clearly, out of 15 megatrends, 12 are in progress. Account aggregator, we expect to end the year with consents of 7 million customers by March 24. Social as a platform. ONDC will go live by June 24. Social as a platform by June 24. Rewards as a platform by March 24. Offline to online, it's already gone live on 5 events. If any of you is a customer, and all offline to online and offline to online to offline events would have gone live by June 24. So between whether you're a store or you're an app or you're a web, you will have a synchronized experience by June 24. In terms of work in progress, clearly two areas, which is vernacular and voice, which are work in progress. On products, pre-owned has gone live. Bajaj Plus would generate this year 2 million loans. UPI is open architecture. The technology infrastructure is ready. We are awaiting regulatory approvals. Monetizing digital assets from an infrastructure standpoint would be ready by March 24. Just a quick update on strategy that we articulated last year. Good product across key strategic blocks of products, geography, platforms, horizontal functions, and subsidiaries. I'm on panel 66. On products, companies launched 5 new product initiatives, went live with emerging corporates, auto loans, microfinance, and tractor finance. As products in the last 1 year. On geography, we have added 139 locations in UP, Bihar, and have created a template which in a sustained manner should allow us to launch all our products in all our locations in a sustained manner over the LRS period. On platforms, well positioned from experience standpoint and from new platform launches standpoint, and continue to invest in horizontal functions in reducing friction and improving resilience and scalability. Just jumping to now what does future holds for us from a rolling standpoint. I'm on panel 68. Clearly, from our internal forecast standpoint, we think the next 5 years rolling, including the current year and +4, the total credit market will grow by 12.7%. Commercial in our assessment will grow by 6.8%, and retail in our assessment will grow by 15%. That's just outside in view. In terms of inside-out view, we are principally or primarily a retail company with 86% of the portfolio being retail and SME, and panel 69 is really what is relevant for us. By 25, what we foresee is that other than agri, we as a company should be able to offer all products that our retail and MSME customers may require from us. It would have been a good 18-year journey in which is the time we would have taken to offer in a gradual manner and a profitable manner, offer all our products to a customer franchise. From a mega trend standpoint, we've identified overall 10 new mega trends. CBDC, nothing on the platform in the current year, 4 key areas of products. While we cannot do credit on UPI, but we think it's a trend, so it's a mega trend, so we'll keep watching it. Non-banks are not allowed to do, as you are aware, but plastic is a form factor, future of device. In technology, clearly generative AI. Generative AI, digital fraud, cybersecurity, and blockchain. So these are 4 areas, and in 3 of them, we intend to make significant progress as we move into next fiscal. Clearly, climate risk, while we are a retail company, but it's a practice we started to build in the risk side of the business to start to seriously look at the impact that it has on whether on retail or on MSME clients. In terms of strategy, very quickly, I am coming to the end of monologue. Please bear with me for 5 more minutes. In terms of strategic construct on panel 72, clearly on products, the ambition is to be among top 5 players in each product line in LRS period. We'll continue to invest in new product lines, clearly to seize India opportunity. People argue, I get questions, is it because you're growing slowly? That is not the point. It is to seize India opportunity and to grow in a sustained manner. That's really our objective. As India per capita grows, as India grows, and given the capital, talent, and long-term orientation that we have, we would like to offer all the products that our clients need. So it's not like, this conversation keeps happening. We're not launching new lines because we're not seeing growth. And for that matter, if you went back to, for a moment, to panel, to the mix point, which I missed actually talking about, the growth in the quarter across, just in 1 second. On panel 49, two-wheeler, three-wheeler grew 64, urban sales finance grew 44. These are businesses that are 17-year-old. Urban B2C grew 29, rural sales finance grew 40. It's a 10-year-old business. Rural B2C, of course, I articulated because it's a risk view that we have. SME lending grew 39. So it's not we're launching new lines because we are short of growth. LAS is a 17-year-old business, grew 45% and so on and so forth. It's because we want to seize India opportunity that, and we have a longer-term view on given our ambition, is why we launch new products. Going right back to 72, on geography, clearly we are at 4,100 locations. We increasingly foresee that we are really deep. It's more products in those locations and branches rather than more locations. So clearly that's the way forward rather than more branches or more locations, and that's why you see the frame to be all products in all locations. On platforms, clearly dominate all digital platforms. We're today at 5 million organic downloads a month. We've got to get to 10 million organic downloads a month. 2 years ago we were doing virtually nothing. If from 0 to we can get to 5 million, we have clear strategy roadmap to get to 10 million a month, to get to 100 million overall net installs as a company in a LRS period. On consumer web, clearly to be more efficient, we got to focus on organic rather than inorganic. We do very little inorganic any which ways, but even otherwise, given our growing breadth, the goal is to generate 1 billion organic hits on the web assets as you move ahead. On horizontal functions, given our growing size and scale, the goal is to solve the hardest problems in our business, to reduce friction on one hand for consumers, scalability for us as a company, and resilience. I think so clearly business function by function, the goal is, you will see, is on 0, 0, 0. On DMS, 0 complaints, on operations as service, 0 paper, to 0 identity mismatch, and so on and so forth. In treasury, 0 liquidity drag. So clearly start to focus on solving the hardest problems is really where the horizontal functions frame is headed to be. We deliver all this, which we have so far done over the last many years. By FY28, we could look like 130 to 140 million customer franchise, 80 to 90 million customers, cross-sell franchise, 3.8 to 4% of retail credit, and 3 to 3.25% of total credit, and should be present in 5,200 odd locations with 120 to 150 million installs. So I think we remain anchored and committed to generating these outcomes on a long-term basis and ensuring that we remain accountable to do that. As we are to the majority shareholders, we intend to do that for minority shareholders. That brings me to the last section of, on a set of key Senior management portfolio changes. As you can see from the LRS update, the company remains pretty excited about its long-term growth prospects and remain highly committed to continuous transformation of the company, shareholder value creation, good customer service, and fostering a supportive and dynamic work environment. In order to prepare the company to achieve its long-term growth objectives, the Board of Directors, as part of its nomination remuneration, have approved the following senior management portfolio changes. They are subject to, the first one is subject to shareholders' approval, balance are internal changes. What the Board of Directors have recommended is for Anup Saha, who's been with us for the last 7 years, subject to shareholders' approval, to move as from Executive Director to be designated as Deputy Managing Director. In addition, to assist Anup, we are creating 3 new Chief Operating Officer positions. Deepak Bagati, who currently runs debt management, would incrementally run debt management, operations, service, and public relations. Sandeep Jain, who currently runs, who's the CFO, runs treasury and investor relations and FP&A, would also run human resources, administration, and legal. Anurag, who currently is the CIO and strategy head, would run marketing and digital platforms as well. Lots of noise about me on an ongoing basis. I thought we'll just put all of that to rest as to what would I do. I'll continue to be actively involved in shaping the strategy of the company and its subsidiaries. Will engage with the CEOs of the wholly owned subsidiaries to achieve short-term and long-term objectives of the company, of VFL and its subsidiaries. Anup will work for me. The commercial lines of businesses will work for me. Risk, compliance, internal audit, and CISO, which are important statutory positions, will also work for me. Rakesh, who's been, me and Rakesh go back 30 years, who's been an important member of the management team in shaping the company, its innovation, and its various control functions, has resigned from the services of the company. He's an outstanding leader and really helped us achieve various milestones. He will be deeply missed. He'll remain with the company till June 30th. After June 30th, he'll remain as an advisor to the company and will work with me. These announcements should make the company stronger. Of course, not Rakesh's departure. He'll be deeply missed, as I said. Subject to shareholders' approval on Anup's appointment, these changes are effective 1st of April. That brings me to, in an uncluttered manner, all that you guys have been asking. The 4 key areas of course, quarter is quarter, but otherwise update on regulatory matter, long-range plan for the company, and senior management appointment changes. I'm sorry for the monologue. I hand it over to you guys for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Viral Shah from IIFL Securities. Please go ahead.
Yeah, hi. Thank you for taking my question. So I have 2 questions. One is basically what gives you this confidence on the urban B2C, where the rising delinquencies, you mentioned that it is transient. I get it that it is lower than what it has been pre-COVID, but given the trends that we are seeing in the other segments of unsecured loans, even including credit cards, are you seeing higher delinquencies even in the higher ticket size PL segment, and how should one think of it?
No, don't think of it. Go by the data, right? I mean, that's why I made the point that that clearly you see in rural B2C numbers slowly go down, which is not how you see in urban B2C. So we'd rather be data dependent than anything else. I think that's the only point I would make at this point in time. Does not mean we are not to remain watchful. Is an important point. But remain data dependent. At this point in time, it looks transient, is what I would say.
Okay. And also as a corollary to this piece of the question only.
And mind you, just as a separate point, if you look at the last 4 quarters of growth, given what we saw on B2C, on the margin, we have cut even urban B2C. We've actually cut quarterly close to 450 to 500 crores of business because at some point India starts to be rural and urban as a mix. So we have in urban B2C on a preventive basis in the last 2 quarters more so have actually 3 quarters have taken action already and reflected in a 3% lower growth on a year-on-year basis. If you look at it, March quarter was 32-33%, is down to 29%. So on a preventive basis, that action has been taken.
Fair enough. And how do you see it going ahead? I know we are data dependent, but any sense on how you are seeing?
Yeah. So clearly, as Viral, we have said that we foresee the number to remain anchored from a guidance standpoint between 175 to 185 basis points, which is really where the number was pre-COVID. So, and mind you, during this period, there are reasonable level of changes that we made to our provisioning policies. Customer level GNPA, just to give an example, never used to exist. There are a whole host of things that never used to exist pre-COVID, but I'm still going by that to make the point. So as you guided as part of this presentation, that we foresee the number to be between 175 to 185 basis points. That's really where the number is likely to be.
Sure. Thank you, Rajiv. And one more question I have is on basically with regards to your entire digital and the text setup we have. So over there, are you seeing some the progress or the adoption on the digital platforms kind of slowing down? Because I see, again, I'm not referring to the segments which are impacted because of the regulatory restriction.
Yes.
But if I look at the growth in the digital app downloads, that is slowing down. The credit card acquisition on app is declining.
Viral, as I said, focus on the star marks. That principally it's a transient because from 16th of November we could not do Insta EMI card. Insta EMI card alone quarterly used to be 150,000 accounts just from the app. The numbers are published, 140 to 150,000 accounts. So take these 2 panels, as I said, on a transient basis. We continue to invest deeply. I mean, I said in the last call actually that by June 24, the asset is getting mostly fully refreshed. And as the January sprint and the March sprint goes live, you will start to see visible changes. So we continue to invest, and digital assets require ongoing investments and ongoing deep investments and deep commitment. So, and as I said earlier, from 5 million a quarter, we have planned to get to 10 million 5 million a month. We have a plan to get to 10 million a month. All organic, mind you. To get to these 49 million, we spent very little money. We just integrated the infrastructure to make it meaningful for the consumer. So answer is no. We remain.
Got it.
Just one point, Viral, I missed. I should have mentioned it probably, that the purpose of the platforms, and it's part of the deck, is to generate eventually 25% of the business. So to give an example, that's why these star marks are creating a transient frame that, let's say, instant personal loan, we stopped on account of KFS. That's why the metrics are looking slower. So just ignore this for until such time there's embargo. Post that, we should be back in a growth mode. We should be back in significantly higher growth mode.
Got it. And just last very small question, more directionally. I noticed that last few months back, there were some changes in the Articles of Association enabling the company to issue credit cards. So is there anything on the anvil in terms of making an application to RBI?
Nothing. No.
Okay. Fair enough. Thank you. That's it from my end.
Thank you. Thank you.
Thank you. Next question is from the line of Abhishek Murarka from HSBC. Please go ahead.
Yeah. Thanks, Rajiv. Thanks for taking my question. So my question is on growth. So you can see that there are, sort of elevated NPA pressures in the system. Also, probably elevated regulatory scrutiny as well. But for you, the growth continues to be pretty strong. And do you see any risk to that or your intentional slowdown, that you've done for maybe a couple of businesses, but on a broader basis, do you see that sort of overshadowing the distribution-driven tailwind that you have for growth?
So the good part of it is that, so there are 2-3 dimensions of this. Growth and risk, margin and growth margin. The fortunate thing for us is the tailwind is that there is strong growth. Okay, so that means we have the latitude, if we want, to calibrate. I'm not saying slow down. I'm saying to calibrate between these 3 dimensions of risk, growth, and margin to ensure we deliver what we call the optimized return on asset and return on equity. As I said earlier, Abhishek, we've launched new lines. The new lines are, so 9-month growth, as I said, is secular across businesses. B2B was strong, two-wheeler and three-wheeler financing volumes were strong, commercial lending was strong. Product mix we expected to remain stable. So I think we'll just continue to pivot and repivot between growth, margin and risk and remain committed to deliver a rightful outcome to shareholders. So growth is tailwind, margin is little bit of headwind, risk is little bit of headwind. I think does that answer your question or you have a follow-through question?
Yeah, actually I do. So let's say, are there any particular segments where you see that for a prolonged period you need to slow down, basically because systemic risks are rising? Or maybe you're not making the kind of margin?
I mean, look, monthly personal loan disbursements are 70,000 crore. We know that our franchise takes of that 70,000 crores a month between 40 and 42, 43,000 crores. Between 38 and 42, 43,000 crores. We only get 4,000-5,000 crores of it. I mean, there remains significant opportunity without diluting risk or margin. So I think the franchise is extremely strong and it's the optimal frame is really where the frame is.
And my second
new lines of business have gone live. Auto is now already doing 200. New auto is already doing 200-250 crores a month. LAP, which we started in BFL, is now already doing 250 crores a month. Those are new lines, but they, as I said earlier, existing lines itself remain a lot of opportunity and excitement in. We'll calibrate between the 3 is all we'll continue to do.
Got it. And my second question, Rajiv, is on asset quality. So one thing, if you can, provide some comment on, what exactly is happening. Some of, your peers are saying that, personal leverage is now become a systemic issue. You've been saying that for a while. And if you look at your own GNPA numbers, in some cases in 2 quarters, it's increased 50-60% or more, absolute numbers. So what's happening in the system? How do you calibrate that, or how do you control that in your portfolio? And second is on the 1.8% credit cost. Does that assume that you will not use any of the management overlay, or you can dip into management overlay going forward? Thanks. Those two questions.
So look, let's take us as an example, right? We remain at ever low GNPA and NPA. And this is, as I said, despite the fact that there have been significant regulatory changes, like I give an example of once a customer, always a customer, and so on and so forth. Eventually, I have a fundamental point of view, and which is really how we are organizing ourselves as a company, is that eventually everything will go back to pre-COVID. Let me make that point. Eventually. Now, whether it happens in FY25 or it happens in 25-26, I don't know, or nobody knows. But eventually, everything will go back to pre-pandemic levels. When I look at across our portfolios, and now coming to risk, across our portfolios, numbers are still significantly lower. Let me give an example. We talked rural B2C and urban B2C. The bounce rates are lower than pre-COVID. The flow rates are a little higher. Okay. Bounce rates are materially lower. Now I'm just giving you texture to make the point. So we have to just keep watching data, Abhishek, rather than go by the casualness of the frame. And I have said this in the past, that rural B2C is not an outside-in problem. It's an inside-out problem. I've said this, so it will be there in the transcript in last quarter.
Right.
Because you may say, why do you say that? You look at rural B2B number. Because that is actually across millions of consumers. Rural B2C is actually across lakhs of customers, whereas rural B2B is across millions of customers. That number was 99.33 pre-COVID. It's still at 99.62. It used to be 32 basis points of stage 2. It's on panel 57, Abhishek. It's at 23. Now, that's the same rural consumer that I gave a personal loan to. So I don't believe it's a system issue or leverage issue. And mind you, our B2B reflects significant mood on one hand from a purchasing power standpoint, and behavior from a credit standpoint. Both urban and rural B2B are not showing that in any given manner. So, is just as a data point to leave you with.
Got it. And just on the credit cost part.
175, 185, we'll keep, I think.
So does it assume that management overlay will not be utilized?
Management overlay, CFO can answer.
Yeah. So Abhishek, I think the number that Rajiv quoted as 179 basis points for the 9-month period is gross of any release from overlay.
Exactly.
So when he's giving reference to 185 as a corridor on the outer side, he is still not counting the overlay release. I think we remain watchful of the external factors which can impact us and the industry. The GNPA remains strong at 95, NNPA remains strong at 37 basis point. We have 590 crores of management come macroeconomic overlay. I think Fakhri is sitting here. He's listening to the call. I think we do annual review of our ECL provisioning methodology, and it is due for revisit in quarter 4. We'll take a final view on the overlay position and what needs to be protected for macroeconomic purposes. So we'll give a final guidance on overlay in quarter 4.
And intend to remain prudent.
Of course. Got it. Thank you so much and all the best. Thank you.
I want to re-emphasize on. The numbers that I talked are gross off. They are not net off. Because if you see the 9 months financials is 161. Whereas if you see my management commentary is 179. And I've written there it's excluding, because eventually management overlay will either get adjusted to
Sending
ECL model, or eventually get consumed. It's not a permanent frame. What is the normalized cost of credit? I think that's more important, or the most important rather than anything else. And that number is 175 to 185 basis points. Having said that, which is what it was in FY20, which was 179 basis points, intention would to 180.
189.
189. 189. Intention would be to continue to remain below that.
Got it. Thank you so much.
Thank you.
Thank you. Next question is from the line of Concall from Citigroup. Please go ahead.
Yeah, hi. Thanks for taking the question. So firstly, with respect to the management changes, now if we look at it, there were 2 executive director positions which were created. Now we have seen Mr. Saha becoming the deputy managing director. So would there be any thought in terms of the executive director positionship, or maybe that seemed to be more like a transient into this management changes which were there?
I think, look, as the company grows in size and scale, and as the need to create more mature organization design emerges, we'll continue to invest. I think our business is about talent. It's about investing in people. The 3 new chief operating positions are new positions that have been created to reflect growing size, complexity, and a need for a more mature organization design. I think that's really, and it's for NRC on an ongoing basis to debate on it and make the decision.
Okay, sure. And secondly, when we look at it in terms of this entire RBI's embargo, so with respect to the submission, so you mentioned maybe in terms of the digital signature and vernacular language is something which is still pending. But otherwise, are we largely done with the submission out there? What has been the early feedback from the regulator? When do we see the embargo getting lifted? If you can just share some sense out there, yeah.
I would not like to make too much comment on it. Have we submitted? Yes. Are we holding on to submit on account of these 2 areas when we look at it highly rigorously? I think as a regulated entity, we'll go by regulators' prerogative of determining the timing of satisfaction to the changes and eventual lifting of embargo. I think that's really all I would like to state, Kunal. And you should,
but in terms of the submission, it's largely done except for the digital signature and vernacular language.
Yes.
Just to be absolutely clear, Kunal, we had given an initial submission to the RBI team. The final submission, after incorporating, as we said, digital signature and vernacular, is yet to be done. I think Rajiv did mention as part of the opening remark that we should be able to do it very soon in the next couple of weeks' time.
Okay, sure. And lastly, in terms of the new product rollout, be it with respect to, say, MFI, if you have to look at it, and the other products, what has been the experience and in terms of the acceptability, because there are already existing competitors out there in many of these new segments. So if you can just highlight in terms of the initial experience with the rollout of these products, yeah.
So new auto loans, as I said, we launched in 85 locations. We're now doing 250 odd crores. 55% of the customers are existing customers. On two-wheeler, which is open architecture two-wheeler, we went live 18 months ago. We're now doing between 27 and 30,000 accounts a month. Again, 55% of the customers are existing customers. We are in 250 locations in that business. MFI is a completely different category for us. So all these 3 lines are off to what I would say very good start. LAP in BFL, new passenger vehicles in BFL, and open architecture two-wheeler. MFI, I have said, Kunal, over time is clearly a LRS view. It's a slow burn frame. We'll build this. It's a new segment as far as we are concerned. We will take our time and build it out. So it won't be like when we are sitting here next year, won't be doing 200 crores like passenger vehicles is doing or LAP is doing. It will take its time, and we are in no hurry. When I say we are in no hurry, we won't build in a hurry. It'll take. So we'll be in only 100 villages by March. We'll be in 200 villages by September. I think Anup is trying to make a point. Sorry. Anup is just reminding me that gold loan is now reset. It will cross this year. It's growing in the rural B2C, which is the point, Kunal, that I made earlier, that majority of the growth is coming from there. Is clearly now we have in the last 12 months or so fully cracked the model, and that's growing in 3-digit growth. Base is small, but I think over the next 2 years, I would say we are very, very excited about the business, and current year we have fully turned that around. So these 4 lines will be meaningful drivers. MFI, etc. will be a longer haul, and we are clearly prepared for it.
Sure. Oh, okay. Yeah, got it. Thanks, and all the best. Yeah.
Thank you. Next question is from the line of Concall from Oaklane Capital. Please go ahead.
Thanks, Raju, for taking my question. First question is, Raju, there was a news flow of RBL and Bajaj not getting the credit card extension beyond 1 year. And normally the extensions are given for longer period. So wanted to solicit your comments and what is the issue out there on the regulatory front. And second is, what's stopping RBI or you to activate credit card given the fact that worldwide credit cards are run by non-banks?
So, Kuntal, I can't comment on regulatory view, but I can comment on that RBI has granted 1-year renewal for a co-branded credit card partnership with RBL Bank. RBI has communicated to the company that it has noted certain deficiencies in its co-branded card operations, and we are engaging with RBI and our partner RBL and are committed to resolve all the deficiencies to the full satisfaction of RBI at the earliest, and may not even wait for 1-year extension, 1 year, to together working with RBL to file our application for renewal. Good you raise the question because I had not covered it, but allows me to respond to that to clarify this stance as well.
So how's the partnership with the DBS coming along?
So whatever on a proactive basis, whatever we would do for RBL, we would do for DBS as well. On a proactive basis.
And again, I know you answered this question on the deficiencies in our documentation on digital loans, but shouldn't the signage of digital and the vernacular be an easy proposition to solve, or given the technology tool sets available on DocuSign, Adobe, Pixel?
Scale at 25,000 or 150,000 loans a day for 1 year, for on a runtime basis, 150,000 loans in a day is where the complexity emerges. For 1 language to 2 language, yes. For 20 languages across all products, we have taken a decision as a company that we would do KFS for all our products. So we are not even doing this for these 2. We have taken a decision that we would do it by March 24 for all our products that we offer as a company. So that's just one added point I wanted to.
Let me rephrase the question, Raju. How many lenders, bank and non-banks, are giving vernacular documentation?
I have that. You guys will have to do benchmarking of. We are benchmarking ourselves.
Okay. Thanks for answering my question.
Thank you.
Thank you. Next question is from the line of Antarisha from ICICI Prudential. Please go ahead.
Yeah, hi sir. Are you audible?
Yeah, we can hear you.
Sir, so the first point, I'm sorry to harp on it again, but just picking up from you from maybe left off last time, this rural B2C problem or the personal loan issue at large, again, is it restricted to the lower ticket segment as you highlighted last time, or do you think given the stress levels being elongated, it's now spreading to higher ticket loans also? And I see the PCR on your ECL chart is still between 62 and 65. So is it fair to say that even now, when the loan becomes NPA, you're able to recover 35-40%?
On an aggregate basis, yes. On aggregate, balance sheet, the answer is yes. So that's the easier part. Antrish, sorry, the first question was?
The ticket size, less than 50, or is it spreading to higher ticket size?
Look, as I said, even in rural, the numbers have come from lower ticket and the value has come from high tickets. I mean, we are at one level shocked that 5 lakh plus growth in even the 1,000 city is very, very high if I take a 4-year view. So, of course, adjusted for pricing, the flow rates of if you don't adjust for the pricing, the lower ticket is higher than the higher ticket. But adjusted for net outcomes that one would want, which is to run a risk-adjusted portfolio, it is our sweet spot, Antarish. It's important for me to make that point remains between 200,000 and 400,000. It's always been so.
Right.
Rural 125,000 to 350,000. I think that's urban corridor is 200 to 400,000. Of course, we straddle across all the way to, you could take a 40 lakh personal loan from us like banks would do, and which we do in large volumes as well. But our sweet spot is 200 to 400 in urban and 125 to, I would say, 350. We don't do less. As Fagri is saying, less than 50 we do not do across portfolios actually. 50 to 75 is some very small part, and so on and so forth. Because most of the lending is to existing customers. Most is being polite. It's to, in fact, it's interesting, right? That even to an existing customer where you take a B2B loan, you pay all of it. You never defaulted. We give you a personal loan, which is only normally to 25% of the clients, and then you see performance with these levels. Imagine if it's an NTB customer, if it's a new to bank customer, the performance would look significantly worse off.
Right. So if you were to look for markers of this, you wouldn't say that the newer geographies that you are entering, the newer customers you're entering, or any particular age bracket or any geography, nothing like that?
Nothing.
Sure.
So there are no, in rural B2C, as I said earlier, Antrix, look at the B2B data. It is reflecting millions from a performance standpoint, not showing. Rural B2C, yes, it is showing. As I've said, it's inside out. We've acted. Growth is down from 26% 3 quarters ago to 10%. And as the management team knows that I am not scared of cutting business. Because we know we are in the business of risk. We are not in the business of lending, we are in the business of risk. And all reduced business eventually leads to control in risk metrics. So, so it will come around.
Sure. The second question I had, Rajiv, is while we definitely are one of the biggest retail financing companies, given the growth rate differentials, the non-retail portion is also increasingly getting larger. I think it's only natural that will happen at this scale. Can you give us some texture on the non-retail segments, in the sense commercial, SME, LAS, all these segments that are growing so fast? One, are there also existing customers who are, the existing retail finance customers who are overlapping in this segment? If not, how do you go about acquiring in these segments? What are the yields like? Who are the competitors? And how is it growing that fast?
Yeah, so SME is actually MSME for us. It's important I make that point. Normally up to 50 crores of turnover. It's important. We are present in 2,000 cities in India where we serve MSME customers, from city number 1 to, I would say, 2,000 odd cities and towns, to small businesses and to professionals. So that's MSME. Significant overlap of that in autos, significant overlap of that. I think that mainly autos and LAP. These are the two clusters that both on MSME and from retail that they emerge. So that's one part. The commercial business is principally 250 crores to and above turnover. 70% would be triple B customers, investment grade, prime rate, prime pricing, compete head-on with leading banks, built originally on domain specialization in sectors, and over time, as we gained confidence, moved more generalist. It principally reduces risk in the overall balance sheet and delivers stability to the balance sheet. It's purely a commercial lending business. The LAS business is runs at 2.3, 2.4x margin and serves HNI clients. Very low on retail. Average client exposures would be 5 crores, which means he's facing anywhere between 12 crores or so of holdings to become a client. Very low on retail, but we're building slowly retail LAS as well. As the markets grow, that's an area of growth from an opportunity standpoint.
Got it. Thank you. And just one last point. You mentioned this PL disbursement of 70,000 crores as a market as a whole. Did I hear you correctly that 4,000-5,000 crores is what you eventually disburse, and the rejection rate is about very high?
Not rejection. We can't seize that opportunity. That customer, either I'm not reaching him in time, or the price at which he wants doesn't work for me.
Got it. And has this 70,000 crores increased, decreased of late in the last 1 or 2 quarters?
No, it is not. But if you take pre-COVID, it's significantly grown. So it's grown significantly between pre-COVID and now. So it's a lot more structural. The adoption of personal loans is a lot more structural. That is very clear.
Sure. Thanks so much. That's all.
I don't have the number offhand, but we do have the numbers even for what was because our franchise was also much smaller, right? Then we are talking 4 years ago, the franchise was 40 million probably, maybe less, 35 million. So, sorry, you can. It's a growth pre-COVID. Yeah, so. This is the entire market. Yeah, and entire stock. Yeah, but franchise also grew during this period.
So this is on the entire market?
On the entire market. So, as Fakhri is saying, that if you take absolute size of the market 4 years ago to today, it's grown 89%. Just an absolute basis. Absolute. 100 has gone to 189. So, Okay. Maybe last 1 or 2 questions.
Yes, sir. The next question is from the line of Piran Engineer from CLSA India. Please go ahead.
Yeah, hi team. Congrats on the quarter and thanks for taking my questions. Few ones. Firstly, on credit cards, and not just this quarter, but last several quarters, the sourcing has sort of stagnated at 1.5-2 lakhs a quarter. Yeah. What really has led to this, and how should we think about delinquencies in credit cards impacting your fee income?
No, it's a correct question. It's a good question. Clearly, we understand from our partners that they've also experienced deterioration like as you're observing across the industry and have contained the growth based on their AIP engines. So clearly, growth has been restricted based on our partners' input on tightening the filtration criteria to reflect prudence.
Okay, so it's on their part, on the part of the banks, essentially.
So they run the balance sheet. I originate on their behalf.
Got it. And it's fair to say that higher delinquencies will lower your fee income or collection fees, right?
Higher delinquency. I mean, there is no causality between the two directly. I can argue both. Actually it's a reverse point, Piran, as I made earlier a point that the default rates versus pre-COVID are significantly still lower. Okay, whether in B2B or in B2C. If I take aggregate bounce rates, they are lower. Actually, and as a result of, you may say, what I think clearly improved banking has had a significant role to play because we've only gone deeper and deeper into India. But portfolio by portfolio we see versus pre-COVID the bounce rates being lower. In fact, that means lower fees, because these were, if my default rates are lower, my default rate is lower, my GNP is lower, there were accidental defaulters who are not there anymore. They are not accidentally defaulting anymore. So it has led to lower fees and charges. So there is no direct causality between the two, Piran, is the only point I would make.
I think the only point, Piran, I would try and draw a correlation is, if there's a high delinquency, I'm assuming that the partner would also take risk action, and that will lead to overall volume being lower. The point that you're asking, 150,000 to 200,000 is where the number is stagnating. It could also be because of the partner is currently seeing some stress based on which they have put a cap. So is there a correlation? Answer is yes, but the correlation is in terms of incremental volume that we can do.
Got it. And then secondly, just probably a little more philosophical, but when we started rural lending 7-8 years back, at that time, the thesis was that rural is actually better than urban because it's less penetrated. We are not, tapping farmers. We are taking salaried people. And I think even until COVID, our performance in rural was actually better than urban. And correct me if I'm wrong.
No, it's
now
correct.
The tables have turned.
Absolutely correct.
Yeah. So I just want to understand what has changed in the last 2-3 years that we are actually more concerned about rural than.
No, I think access has improved.
But that would be for urban also, right? The 70,000 crores you mentioned, and I would assume 80-90% of that is in urban. Or is that not the case?
No, your principal point is correct, but clearly we could pick and choose more earlier than now, given massive supply. I think is the only logical response I would give. I mean, I think so. Clearly, our ability to pick and choose, given significant competitive activity and increase increased supply side, has sharpened the funnel for us. I think that would be a reasonable logical conclusion. Having said that, I think I'll repeat for the third time. There is work to be done by us, inside out, which we will do.
Okay. This significant increase in competition is from banks, right? Because I can't fathom other NBFCs having the distribution that you have.
Yes. It's mainly banks, I would say, public sector banks. Mainly. Significant supply side increases from them. Because they only have the distribution, not for anything else.
Exactly.
I'm not making any other point except just pure access in the smallest of the market that we're talking about.
Got it. And just lastly, one clarification. You mentioned you've increased yields by 25-30 bits. Yes. This is across all unsecured products or across all products?
No, secured has a bigger problem. So it's across all products. I mean,
even mortgages.
The cost is rising. Yeah, even mortgages. I mean, the headline rate may not have changed, but we are being lot more choosy in pricing and picking up transactions. Clearly, I mean, look at where liquidity is gone. Look at where cost of funds are going, and at our scale, every month. And we run a short balance sheet, right? On aggregate, the aggregate balance sheet churns in 25-26 months. If you take a behavioralized maturity, the balance sheet churns 25-26 months. So we got to act quickly, because then we can make up quickly. If we act later, then we will make up later.
Got it.
We've acted. I mean, and I go back to the point that in the process Abhishek was asking that, and I was telling him the calibration is between risk, growth, and margin. We'll just keep calibrating. Right now, to me, the greater weight is on risk and margin than on growth, because we have tailwinds on growth any which ways.
Got it. And lastly, what is the customer level GNPL thing you had mentioned once? Is it that if a customer is NPL with another lender, he's NPL with you?
Sorry.
You referenced customer GNPL. You said things have changed.
Yes.
I think Rajiv was drawing reference to the once NPA, always NPA circular of RBI, which said that only when the customers all dues are paid can the customers upgrade. That's a change that has come in November, I think 2022, if I'm not wrong.
Correct. Okay, fair enough.
And I'm making that as a point. There are many such changes between 2019-20 and now that have emerged to draw a parallel to the GNPA and NPA conversation and to loan loss to average assets conversation.
Got it. Okay, that's all from my end. Thank you and wish you all the best.
Thank you. Samir, we can call it a day.
Thank you very much. Yes, sir. Ladies and gentlemen, we'll take that as the last question.
Is it okay?
I'll now hand the conference over to Mr. Samir Bhise for closing comments.
Thank you very much today for joining this conference call, and thank you to the management team of Bajaj Finance for giving us the opportunity to host the call. You may now disconnect. Thank you so much.
Thank you all. Thank you all for patiently hearing.
Thank you very much. On behalf of JM Financial Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.